Hey, welcome to Let's Talk Real Estate. I'm your host, Charlie Flannery, and my guest today is a longtime friend, Mr. Jason Bonarrigo.
Hey, Charlie. How are you?
Hey, Jason. Thank you for coming on.
Appreciate it. Thanks for having me.
Jason is a senior analyst for a national bank. I can't mention their name, but he arrived by stagecoach and he's double parked out front. So we've got to kind of move this quickly along. But thanks again. And
Thanks for having me.
you know, your dad Tom and I have been friends since you and my daughter Nico were about this big.
Many years, yeah.
And that's going on years ago. You know.
Don't embarrass me, yes.
Yeah, don't embarrass you. Don't embarrass me and your father, you know. But great to have you on.
Thank you.
Great
Thanks
to
for
have you
having me.
on.
Appreciate
I'm
it.
looking forward to a
Always,
good show.
Always look forward to it.
So let's just cut right to the chase.
Sure.
You know, I mean, everybody hates the banks today.
Me too. No.
So let's. It's an honest program, you know. But you know, tell the folks what you guys are doing to try to fix things.
Well, that's assuming that that you're saying that they're broken, and I know, but I know what you're getting at. Obviously, I mean the landscape of lending in the credit environment has changed dramatically over the past 2 to 3 years. So I think we were talking about it with another colleague of mine yesterday that unfortunately it's a classic overreaction to kind of what I like in the wild wild west of 4 and 5 and 6 years ago, when anybody could get a mortgage and they probably shouldn't have. So I think it's an overreaction from Fannie Mae and Freddie Mac and FHA, and really tightening the belt on those guidelines. So we're hoping to see that ease over the next couple of years. How that will play out, and when and how quickly that'll come, I'm not quite sure. But again, it's just we're trying to issue mortgages and credit to credit-worthy folks. And we're making them go through the ringer a little bit. I'll be the first one to admit that, because we deal with it on a day-to-day basis. But we're trying to alleviate that. We're trying to get out in front of it and set the proper expectations going in. I think that's the biggest key for obviously all the realtors out there and other analysts and other originators. It's just about setting the expectation with the consumer and the client. This is going to be difficult. We're going to apologize for it up front and let them know that, but at the end of the day, you'll be able to secure the financing, get you the home that you wanted.
You had mentioned Fannie Mae, Freddie Mac,
Of course.
and FHA. Now, there's been talk that Fannie and Freddie are in so much hawk that they may be dissolved or done away with.
Yeah.
And are you guys still involved with them as far as the secondary? Are the major banks, Fannie and Freddie, still major players as far as moving that money?
Yes. Well, yeah. I mean,
And what happens if they go away? Where do you guys end up?
Well, I think that's a whole different model, and I think that's a big question that I can't obviously answer today. But yes, there's obviously been some things that have come out. The president and Congress have gotten together and talked about kind of what to do with Fannie Mae and Freddie Mac and FHA. The numbers show just basically, I think if you go back 2 to 3 years ago, Fannie Mae, the agencies, if you will. Fannie Mae, Freddie Mac, FHA had about 52% of the mortgages in the country. So about 50-50. Obviously, everything else was the small savings and loans and the private banks and equities. Right now, that number is over 90% of all the mortgages sold in the country go to the big three, if you will. So they look at that and they know that they're going to have to pay the piper at some point. Obviously, essentially, all three of them are government-owned agencies right now.
So when you say
how do we correct that?
When you say they are going to have to pay the piper, you mean you, me, and
everybody else.
every working stiff is paying in?
On the tax side of it, of course, unfortunately, for U.S. citizens, but also Fannie and the government are going to have to address it, and I think they're trying to. Of course, we've seen three different kind of
There's no money in
proposals.
trying. The money's in getting it done.
True.
I was told that a long time ago.
That's true too. That's true too. That's true too. And
Trying's
I think
nice,
Well, I mean, that's the key, and it's how do we?
T-ball. Trying's good in T-ball. Once you get to the major leagues,
That's true. It doesn't work. Right.
You got to produce.
It doesn't work. You're right.
So and now, how much inventory the banks in general still sitting on? You know, stuff they foreclosed or are in the process of foreclosing.
Well,
What's
I
that
mean,
number close?
that's a hard number. I would probably say, I mean, you can't quote me on it, but it's probably about 30%. You know, 25 to 30%.
Of what? I mean,
Well, of their
can you-
existing pipeline of kind of what they're looking at.
so is that what, 10
modific-
million houses?
Yeah, I would think that's probably around the 10 to 15 million range. You know, obviously I know some of our internal numbers, but I can't really, you know, quote that. And obviously it's bank by bank, obviously, you know, size by size and
But you guys
smaller
must
banks,
get those industry publications that says, holy mackerel, you know.
Well, we do, and of course.
It's 30% everywhere we talk, you
Of
know?
course, and then there's rumors on another wave of foreclosures coming on. But again, it goes bank by bank, lender by lender. Obviously, kind of goes back to what you just started out with. We're trying to stop that, so obviously lending going forward is to folks who can really, really afford to own a home and make the right decisions financially. Some things that's out of their control, obviously the job market, oil prices, all these things that we can talk about for hours on end, but you know, that's the key. That's the factor, is trying to set that expectation limit that homeowners should be. It shouldn't come easy. You know, it used to be hard work when you went to see your banker. You know, people used to get dressed up and be nervous about it. You know, unfortunately, again, we all did this to ourselves. We created an environment where it was easier to get a home than it was to purchase this coffee table. So that's probably not a good thing. And neither is this overreaction, and hopefully we'll end up somewhere in the middle over the next couple of years.
Yeah. Well, I had just done a series on foreclosures.
Yeah.
And one of the things that was mentioned was that if a lender obviously didn't sell it at the foreclosure sale,
Yeah.
took it back, it became what's called a real estate owned or other real estate owned to
REO, yeah.
differentiate it
Sure.
from where they have their branch office. I know you understand. I'm just saying this for the folks.
Of course.
So they know what we're talking about.
Yeah.
But it came to light during that series that if the banks allow that process to take place, it goes to foreclosure sale, they end up taking it back, they hold it for a while or season it, then turn it over to a asset management company or whatever to sell it, okay, that they're reimbursed. Do they get reimbursed by Fannie or Freddie for that money? So let's say it was a $200,000 note. If nobody shows up to bid on the day of foreclosure, the lender takes it back. Say a year later, they end up liquidating it for $100,000. Doesn't Fannie and Freddie reimburse them a large chunk of that loss?
Yes and no. It really depends on the servicing agreements that you negotiate with Fannie and Freddie and FHA. Again, lender by lender. Obviously, I think, you know, depending on the size of the lender and the agreements that you have in place to service the mortgages. Obviously, if a big bank is providing 100,000 service agreements a month, it's a little bit different than your local or mid-level savings and loan who's maybe doing 20 or 30,000. So it's kind of that bargaining power that goes there. Also, I think both entities are usually on the hook as far as some of the loss, to negate the loss. So obviously Fannie or Freddie or the agencies are going to absorb some of the loss, and of course the lending institution as well.
You know, and it just seems to me that while you mentioned, you know, they're tightening up the criteria for who is eligible for a loan.
Right.
Good thinking. I
Yeah,
mean, you know, we
of
don't
course.
want to go back to the days when, you know, they give you a mirror test. If there's
Right.
a little fog,
That
you're
was it,
approved,
baby,
you know.
you're all set.
But, you know, that's part of the solution.
Right.
And then liquidating this 10 to 15 million homes inventory.
Yeah.
That's something that's got to be really accelerated. And if it's Fannie or Freddie that has to step to the plate and expedite it, because it would seem that it's in the bank's best interest to let that program play out. And maybe not in every case, because as you said, each service or agreement is different.
Of course.
But there has to be some pockets out there.
It's
you know
true.
what I mean?
Yep.
Where it's in their best interest to let the thing stall, and they'll lose less money.
A little bit. I mean, I agree with you partially on that. It's funny. There's two schools of thought on that. We were just debating that, actually, just kicking around the office about 2 weeks ago, talking about kind of what should they do with this next wave of foreclosures, coming through? So it's, do you release them all at once and kind of flood the market? Because, we've seen some growth in some certain areas. And remember, again, we're talking, folks, on a national level here. We're not talking on a local level. Massachusetts, as you can attest to, has been pretty stable. Obviously we've had our pain too, but there's pockets. There's California, there's Florida, there's Vegas, there's the Midwest, and obviously with Detroit and all those areas that are hit so hard, real distressed markets because there's no jobs. So again, that's where the bulk of this volume comes from, in pockets. So do you affect Massachusetts and some other states that are really trying to turn the corner and rebound and have actually seen some growth in the housing market? Or, to your point, do you hold and kind of let them out piece by piece so they can kind of get in there, and you don't want to saturate the market and bring down the overall values of everyone else who's in good standing, and then it affects their home values as well. So we're going to see how that's going to play out, obviously, over the next 6 to 12 months.
Yeah, I could see
Should be interesting.
I could see where, there would be a school of thought to say, let it bleed. Put them all out there, see what happens. But what might happen, it'd be almost like the California gold rush. A lot of investors would go out there, buy them for 50 cents on the 40 cents on the dollar,
right,
figuring that I'll be able to sell for 60 cents on the dollar inside of 5 years.
Right.
One of the things that's gotten lost, I think, in people's view of real estate because of the down market lately, right, is one of the strengths of real estate as an investment has always been the fact that you're highly leveraged, and everyone, hates the banks, just like everyone hates the lawyers until you need one.
Right, of course.
Lawyers, they're terrible, you know what I mean? But now that, you're facing litigation or whatever it may be, you want a good lawyer.
Of course you do, right.
And when you need a loan...
Necessary evils, right?
Yeah, exactly. When I want to buy a house, you guys got the money, I got to come to you.
Right.
Right. So,
right.
It's,
and we're dealing with that on a PR perspective. What
sure.
I mean? Obviously on a day-to-day basis.
Sure.
It's, again, as I touched on earlier in the show, it's about setting the expectation with clients and informing them, and it's a moment in time, and it's going to be difficult, and this is all about what happened in the past. And again, you're paying for the sins of folks in the past, and it's just about kind of working through that. And obviously, some banks have navigated these waters better than others.
If you
they're
can
still standing.
Yes. If you can view this through a 5-year window going forward.
That's the key.
Now, let's say I buy a condo for $100,000. I put 10% down, $10,000.
Right.
All right. In 5 years, I sell it for $110,000. Okay. I made a $10,000 return on my $10,000 investment. I got a 20% return.
Mm-hmm.
Where are you getting that today?
Nowhere.
Right. Granted, we've gone through some tough times, but the beauty of real estate is that you leverage that and you amplify your return on your investment.
Sure.
That's where you guys come in. We
right.
need you for the other 90%, or
right.
else we can't get in the game.
You can't get in the game.
We don't
right.
like you.
Right.
You know what I mean? We got to keep an eye on you, but darn it, we need you.
Right, of course, because we have the money, we have the capital. As I always tell clients, for good or for bad, and referral partners, that we're the oil that makes the engine run. I mean, without the liquid capital, it doesn't work. And obviously, that was what really happened in early 2008, and extended into 2009, where nobody was lending. It was an issue where everyone just froze because they were so nervous. Obviously, that's back moving again, and that's a good thing. So, we'll see if we can continue to grow it.
Yeah,
Yes,
I remember attending a seminar, and this was back in, I don't know, something like 2008, and they were telling us that they had been writing those 80-20 loans, basically the no money down loans,
sure.
or the liar loans, whatever, right up through 2007, right up through the middle of 2007, they said. And they were finding that the stuff would hit the fan at around the 2-year mark when those things, the rates on those mortgages would adjust. people's payments would jump suddenly from $1,500 to $3,500 a month.
Well, the option arms is, I think, is the key there. Is obviously it was started out as a modest interest-only payment, and all of a sudden it jumps to a fully indexed payment, and people are hoping to get out of it or refinance or sell that property or flip it for a quick gain.
And the lion's share of the foreclosures that I read about, they were written up in 06, 07,
Sure.
05.
Yep. Yep.
And
it was a double component.
yeah,
Double component
So
on that.
it was a double whack.
Sure.
Listen, we're coming up against a hard break for a couple of public service announcements. Please stay tuned for more of Let's Talk Real Estate.
Some things require experts at every stage.
It's one small step for man, one giant leap for mankind.
Others are more just a matter of taste and preference.
Just the way I like them.
Buying a home falls somewhere in between. That's why you should visit HomeLoanLearningCenter.com for expert guidance. A website where you can learn just how you should go about buying a home. You'll get facts, tools, and impartial advice. From seeing a lender to settlement and beyond, there's a step-by-step explanation of the process. All at HomeLoanLearningCenter.com.
Houston, we have a solution.
Think of it as mission control for buying a home. That's HomeLoanLearningCenter.com.
This is a message from HUD, the U.S. Department of Housing and Urban Development.
Can you afford your home loan? Could your mortgage payment increase in a few months to something you can't afford? Hi, I'm Ruby D. If you're not sure you can continue to make your mortgage payments, call a government-approved housing counselor in your community for free and confidential help. Keep your home. Know your loan. Call today.
Call 877-HUD-1515. That's 877-HUD-1515 or go to HUD.gov.
Welcome back to Let's Talk Real Estate. I'm your host, Charlie Flannery, and my guest today is Jason Bonarrigo, a senior analyst with a national bank who arrived here by stagecoach.
That's right.
Okay.
Outside.
We covered a lot of good ground in the first half, I thought. What do you think's going to be the impact on American mortgage money availability, credit availability, the impact of what's going on in the Middle East, the price of oil, the meltdown in Japan? How's that going to affect us?
Well, it's already affecting us. I mean, really on a day-to-day, intraday basis. Unfortunately, and of course, the biggest thing is obviously, you have human suffering involved. So, it's tough to talk about the markets and how it's affected, but it's the world we live in.
Yeah, but as long as the gas stays cheap, we don't really care.
Right. He said that, though. But it does. It obviously affects everything, and the markets have been very, very turbulent since that's happened. Obviously, Japan is the second biggest holder of our treasury debt in the world, obviously, besides us, of course, besides the U.S. So
you're saying we could catch a break?
Yeah, we might be okay. No.
No.
So that's obviously a cause of concern when they have the most treasuries out there. And China has a boatload too of our treasury notes. So that's obviously, we've seen that in the treasury market, which is a guide for our interest rates, as you know, is the 10-1 adjustable. The T-bill. And then obviously with oil prices and inflation, we've had some concerns there. So it's been very, very volatile. Again, even kind of when prices come out in the morning and how they can swing dramatically, for good and for bad, on both sides of it throughout the day, based on what's coming through overseas and what's happening in the Middle East. Because you can leave the office and the market was up. Obviously, you go to bed, everything happens on the other side of the world, and then you wake up and the market's completely changed. So, it's really tough to navigate that on a daily basis. And again, it's about constant contact with the clients and letting them know to get those opportunities to lock in those interest rates when you can and jump on them. So,
now, I don't know which is going to play more of an important part, but whether it be the what's going on in the Middle East or Japan's
issues.
Strife and the money they got to lay out there.
Yeah.
But we've got to be facing some kind of a inflationary tsunami down the line. I just don't see. I mean, with if you've been to the supermarket lately, you know, God, there was a time when I could barely lift $100 worth of groceries.
Right.
Now it's like, you know,
That's
I can
nothing.
do it, you know.
Yeah. It's a half a bag. Yeah.
Yeah.
I mean, obviously that's
And gasoline.
that's the gorilla in the room, right?
You know,
it's-
don't interest rates have to, I mean, don't you, what do you think?
That's the concern. I mean, I don't think they're going anywhere in the short term as
Yeah.
far as, you know, they're kind of low levels right now. And again,
Define short term.
I would say the next 12 months to 24 months.
Really?
Give or take. Yeah, I mean, obviously, again, it could all
Yeah.
change with another.
But still, that's longer than I had thought.
Yeah, I mean, to be honest with you, I don't think they can go real high. And if they do, then we're all up against it for, obviously,
Yeah.
I can't say what I want to say on TV, but,
Yeah,
you know,
yeah.
we're all up
Without the
against
paddle.
it without the paddle, let's just
Yeah.
say. So think about it. You know, it's funny, we always joke about it, but, you know, when you hear your parents say or other folks, oh, I bought, you know, these interest rates are so low, I bought my first house at 18%. Well, you did, but you paid $47,000 for it. So it's all kind of equal. You know, obviously the first time and mid-level buyer cannot have an interest rate at 10, 12, and 15%. No one would buy a home, obviously, right? So we'd be in much worse state than we are. They can't go much higher than, let's say, 6, 6.5, 7%. You know, I can't see it. Nobody will be able to buy a home, not at $400,000.
It's the one immutable fact of the equation. And I can tell you this after 27 years of practicing real estate. You know, Joe and Mary, they make X amount of dollars. You know,
Right.
Other than career advancements, their paychecks have not kept pace with inflation in general.
Right.
Right. But you can take that, and I don't know if the lenders still typically would use the ratios of, like, you can spend 28% for housing and 36% for housing and
We
other
still do.
debt.
Yeah.
Okay, so
it's about 40 to 45% of your total debt. We
Yeah.
take the gross monthly income and we divide all your bills, if you will, your car payment, your student loan, and
Yeah.
of course the housing payment, which is the big piece of that.
Yeah.
And we like to see it cap out at about 36 to 40% of
You
your
know, and-
gross income.
Yeah, and the problem with most Americans is we're burdened with debt. We're in hock.
Sure.
You know what I mean?
Yes.
We might be making 50, we're living like we're making 75. We're making 100, we're living like we're making $1.50.
Well,
you
that
know?
was the problem of a few years ago too, especially because all
Yeah.
those folks were trying to buy homes, you know, and they
Yeah.
were buying homes and they were
Oh, yeah.
successful at it.
Yeah. Well, it didn't look that bad because they were lying about their income.
True.
So it was really, yeah,
Right.
Yeah, it balanced
Evens out, yeah.
Yeah, it did.
Sure.
But that immutable fact has always been what that young couple
Right.
is earning, taking that percentage that's allowable, and dividing it by the cost per thousand of whatever that day's interest rates are.
Sure.
Equals price of home plus the $10,000 they borrow from Uncle Tony to buy their
To buy the house or for mom and dad on the
You know what I mean?
Yeah, and you bring up a great point, Charlie, because that's the positive of all this,
Yeah.
is that when I'm sitting down with clients, and especially first-time home buyers, because that's the bulk of the market right now, really, because obviously the trade-up buyer has to sell their residence, and it's difficult for them
Yep.
to do that and take advantage of kind of the new market, if you will. So obviously we've seen a flood of first-time home buyers, as we should, and that's exciting. But the key is that they've almost learned the lessons, even though it's only been 2 and 3 and 4 years. They're very educated, obviously, with you know, being online and doing a lot of research themselves prior, so they're very prepared. And they have a number in their head, and they feel comfortable with it. I think they've watched some families, some relatives, or someone close to them be affected, maybe unfortunately lose their home or something like that. So they come in and they're pretty grounded. You know, nobody's trying to buy a $500,000 house when they should only be buying a $300,000 house. And that's good news going forward, right? Because that's what we want out of the first-time home buyer market now. So it'll sustain, so we don't repeat the same mistakes in the next 5 to 10 years. And that's a great sign. I think that's a positive sign.
Yeah, that's the ultimate arbiter. And the one thing I was encouraged by that you had said earlier was that you anticipated that rates should hover relatively where they are.
Give or take a half a point or so, but
yeah, half
we'll
a
see.
point is nothing.
We'll
I mean,
see.
you're talking
Obviously,
3 or 4 points. That's different. You know, I came in like I say, 27 years ago, the rates were dropping from the teens,
Right.
and then they hit about 12%. I remember when they hit 10%.
Can you imagine?
I mean, it was almost like you felt like a lion tamer, like
Right.
you needed a chair and a
To
whip
keep 'em away.
to keep the people. It was like 10%.
Or run on the banks,
It was
right?
like,
In the
yeah, it was like
reverse
free
way.
money.
Right,
It was,
right.
people thought of it as free money. So,
Right.
but now
It's all relative, though, isn't it?
Exactly. In fact, I got a relative who borrowed it at 10%. Now anyway.
Right. Boom.
But yeah, if you take that same formula that we were talking about, and the interest rates should jump from around the 5-ish where they are now to something 7 to 8.
It's not what we want.
Oh my
and it's
gosh.
not what the market wants, what Wall Street wants, and what the government wants. Because they know obviously all the goodwill or anything we've made in this recovery, quote unquote, long road, will just get burdened again. Because the housing market's the biggest piece of this recovery, isn't it? So that's the key.
Absolutely. I mean, in fact, there was a while there in the early 2000s when the rest of the economy had tanked. And it was the refinance boom and
housing
everything
market
that was
just
the
kept
engine
chugging.
that kept things humming.
Right. Yep.
Otherwise, we probably could have hit the fan,
Right.
a long, long time
A
ago.
little bit quicker than we did. I agree.
But now, what is the ultimate arbiter? What is the major determining factor on what rates become? I mean, Sam Bernanke can't just arbitrarily. I mean, he can say the interest rates are 0, and
they have been.
And
The
and
Fed
yet,
rates.
and yet, if I'm some pension fund in Utah, and I can get 7% for my money somewhere else, I need to get a little margin above that because if I can get 7% from T-bills, if the government has to keep borrowing,
Right.
and they got to start paying 7 to move them,
Right.
you got to move that paper,
Right.
got to come up with it somehow.
Right.
All right.
Yeah.
If I can get 7 guaranteed by the government, and now instead I want to buy $200 million worth of a bundle of mortgages.
Mortgage-backed
I got to
commodities,
get a
right.
premium above that 7%. I got to get 8.5 because there's more risk involved than the government.
Sure.
So as the government continues to borrow, the price of oil keeps going up. I mean, these are the things that none of us have control on.
Of course.
And I think when you were saying 1 to 2 years, I felt good. I was happy hearing
Right.
it. And
But you can't take it to the bank, quote
yeah,
unquote. I'm
I
just
want to
giving you,
have faith.
I'm
I
giving
wanna
you my opinion, and of course,
I
I
want to
just
see Jesus come down from the mountain. I really
Please,
want to believe.
please.
Please keep
Yeah.
him at 5% for 2
right
more years.
for a little
yeah.
while. I mean, obviously, when the rates move, it's tied to many, many factors, and that's got even more complicated over time. On your point, the mortgage-backed securities market, the treasury market, what's happening on Wall Street, and the biggest factor is what we just kind of touched on earlier with the Middle East and Japan, and to quote one of my favorite books, that the world is flat. It's a flat economy now. So it's not just the U.S. economy; it's a global economy.
Yeah.
So many factors are tied into what we're seeing in interest rates, what they're seeing in the UK and across and overseas, and that's the game that people play every time. And again, a mortgage is still a pretty sound investment because the bulk of the folks actually pay it back. Besides all the negative stuff that we've been experiencing over time, most folks actually pay their mortgages back, and it's a pretty good asset to invest your money in over the long term.
Yeah.
But you got to be in it for the while.
Yeah, well,
So-
if there are any of you pension funds listening in, you can still keep buying mortgage-backed securities. It's a good thing. But I'd like to thank all of you who tuned in today for this episode of Let's Talk Real Estate. If you'd like to get a free copy of today's episode, you can send an email into letstalkrealestate@verizon.net. If you'd like to ask a question of Jason Bonarrigo, or if you'd like to send a threatening letter, you can also send that email to letstalkrealestate@verizon.net. And like I say, if you do want that free copy of today's episode, please include your name, your phone number, and your address so we can contact you to verify, because it costs us a couple of bucks to get it sent out to you. And that's only for the first 100 respondents. We can't keep doing this all day. I'd like to thank you once again, Jason,
Thank
for
you,
stepping by.
Charlie.
You've
Always a
been
pleasure.
beautiful.
Always a pleasure, sir.
All right.
Appreciate
Hey,
it.
Be safe out there. Thanks. God bless.